We're going to talk about Dollar General, ticker symbol DG. Uh, Over the course of 1 year, down 45%. Year to date, down 46.6%. So Dollar General reported their earnings, I believe, this morning, and they were a miss on top and bottom line. It is also reacting a lot to what was said in their earnings report, their 8K. So starting down here, these are statements from the CEO, and the first statement, while we are not satisfied with our financial results, we made significant progress in the second quarter, improving execution in our supply chain and our stores. Not a very good first statement there. All right. So next, they're saying we executed nearly 850 real estate projects during the quarter, further extending our reach and expanding our ability to serve both new and existing customers. Um, so you're trying to expand when you're not satisfied with your financial results and your earnings. When we get to the financial side of things, the balance sheet, the income statement, stuff like that, in my opinion, I deeply question why they're doing so much projects, opening up so many more stores when they're not even making money really. I mean, their free cash flow is negative now. Um, so moving on here. While these investments will pressure our 2023 results, we believe they will further strengthen our foundation as we move into 2024 and focus on driving sustainable growth and creating long-term shareholder value. Okay, that kind of doesn't mean too much to me when I read that anyway. So they're saying that their gross profit rate decreased was primarily attributed to lower inventory markups and increased shrink, so more theft. It markdowns, inventory damages, which I feel like is not unusual, obviously. The consumables category, which generally has lower gross profit rates than other product categories, that was the greater proportion of their sales was the consumables. Coming down here, so operating profit, I shouldn't use red, but I'll read this off. Operating profit for second quarter 23 decreased 24.2%. Man, interest expense for second quarter of 23 increased 95.7%. It's just not looking good at all. And then down here, net income, a decrease of 31, just call it 31% compared to second quarter of last year. So the total remaining authorization for future repurchases was 1.4 billion at the end of second quarter of 23. So they didn't buy any shares back, which strikes me as two things. The company either needs the capital, which I believe, or they see their stock price decreasing more, which I also believe that that I think they believe their stock is still overvalued, or they see further downside to their stock. Because if they're buying back their shares, they would see this potentially as, okay, we're hitting a turning point. We're going to start, growing again. They're the ones that get to see all the numbers, all the data before we do. So when you see them buying back shares, it makes you think, okay, maybe we should be stepping in as well. And also, because of all this downside to their financials, all these negative numbers coming and everything's negative, not by a little bit, but 30% on, I mean, big numbers. I think their dividend is at risk. I think there's a good chance if next quarter doesn't turn around for them, they're going to have to slash their dividend. They have net sales growth rate in the range of 1.13 to 3.3. They dropped it. Like you're already at 3.5 to 5. Now they're looking at net sales growth of almost zero, basically. I mean, they dropped it almost in half. They cut it in half. And then now they're, it's not looking too good over here at Dollar General. All right, so we'll come here to we have the balance sheet here. Currently, they have $353 million in cash. Okay, and intangibles down here, they have $5.5 billion of intangibles, which in my opinion only gives them an asset value of 24.8 billion. Down here, they have $6 billion of short-term debt, and they've only got $353 million of cash. Do the math on that. That's not good. Come down here, they got leases. I take leases out and stuff like that, so they can get out of those if needed. So they've got a total about 13 billion dollars in total debt. Come down here, we got gross profit 31%, and then operating profit is only 7%, and then finally net income. They only make like 4.8% off of net sales. Free cash flow this quarter, or sorry, this the past 6 months, they are now negative free cash flow. They are negative $41 million for the year. They will be negative if they keep this up about $82 million for an annual free cash flow. And keep in mind, they've got what $353 million. So they've got 4 years of cash sitting on the balance sheet to cover their free cash flow. And with how quick this is declining, I can't imagine it's going to get better unless they start turning things around. Because if you look here, their last last year this time they were positive just shy of 300 million, and now they're negative, 41 million. So they've decreased by 350 million in 1 year. Um, not good. And then also they added $1.5 billion in debt and only paid back 8.9 million in the last 6 months. Um, I'm not seeing anything that's giving me the warm and fuzzies about this company right now. Um, and then down here, I mean, new store openings. They just keep opening more new stores, which, that'd be fine if they were cash flow positive. If their numbers were like this last year, hit free cash flow, their balance sheet this, they're making some money, their income's going, at least growing by 2, 3, 5%, something like that, but not shrinking by 30% and stuff. Like, I this also strikes me as a bit of a red flag. So that's it on this. I don't see anything that excites me on Dollar General yet. Valuation spreadsheet. Ticker symbol DG. Currently trading $132 right now. Return on invested capital 20.9%, which is solid. They've got a 1.5% dividend yield. Future EPS outlook, and I got a funny feeling these numbers are going to change because these have not been updated as of the earnings that came out this morning. So these numbers are a little off, I'm pretty sure. So looking forward out 3 years, EPS 4.8, 3 years on revenue 5.63. Those numbers come up to here. Gives us a result of 0.5 on the Peter Lynch value, which anything less than 1 is bad, overvalued. Peter Lynch fair value sitting at about $51 per share. Come over here, we have multiples of similar companies here. $225, we'll call it, for a multiples price for Dollar General. Manual PE, market cap, cash, debt, cash from operations gives us 37.7 years before Dollar General equals its current market cap. And that's very, very overvalued. That's like a growth company type of valuation. And just so you guys are aware, the debt that I mentioned and the intangibles here, I did not account for those. When I read the balance sheets, that's how I see it. And I think those shouldn't be in there. I don't think they're worth anything. And especially when you have leases, I don't think those should count as debt either. But that's how they do it on, for, all their accounting type of things. But so when I value companies, I just do it as based on how the balance sheet is and income statements are all written out. So total assets, 30.3 billion dollars. Total liabilities, 24 billion. Outstanding shares, 3.7 billion outstanding shares. So currently, I did not do an average on this one yet, but we'll just call it 3. But either way, price to book ratio is below 1. Even when you're below 1, based on all your liabilities, you have, your assets, you have more assets than liabilities in total, not including intangibles and the leases. Even then, it'd still probably be a pretty solid price to book ratio here. So whenever you're negative below 1 like this, it's always good because then your price to book is you're trading below what you're actually worth, right? For like if you were to sell everything, you have instead of you're paying like 60 cents on the dollar basically for the company. Graham's valuation, because it's a more established, mature company, I got two in there. AAA corporate bonds 4.93, intrinsic value of $171 per share. When we're here to discounted cash flow, we got in all of our numbers from our income statement. Gives us a weighted average cost of capital of 3.43. Auto populates over to here. We have perpetual growth rate 2.5, growth rate of 2%. Now I plugged in all of their cash from operations and their CapEx here. And if you look, cash from operations 1.8 to, let's just call it 2. In 5 years' time, they've only increased their cash from operations $185 million. Their capital expenditures 600, call it 50, 650 million, up almost equal to their to their cash from operations. It is increased by almost 3x. I mean, it's closing in on it, two and a half. And this hasn't increased hardly anything. So big red flag there on the free cash flow side of things. Um, so future, their free cash flow, as you can see, has been slowly climbing, big jump, big decline, huge decline. Looking real bad. Average growth rate 1.54. Analysts predict 3.6. I used 2. I went in somewhat in between there. And that comes down here and gives us a discounted cash flow per share of $5.41. So, last but not least, Rule 72. Current EPS 10.61. Lowest EPS growth rate was 4.77. So we use 4.77, goes into 72, 15 times. 15 goes in 10.6 times, which then what I'll use instead of doing one full year of increase of, or one full double of the EPS, I just did, roughly a guesstimate of, I just gave it a 17 for a future EPS. And that gives us a fair value of 40.83, purchase price with 30% margin of safety, $28.58. Come over here, here's your summary of all your numbers, and gives us an average price of 102, purchase price of 71. So what I'm going to do is I'm going to take the discounted cash flow out of here and see what that does for us. So that bumps us up to 125, call it 126, with a 30% margin of safety of 88. And currently it's trading at 132. Um, and if we come over to the stock chart real quick, it reached 126, I believe, in post or potentially even today, but it's in this area. And this is where it would, if we get rid of that discounted cash flow, which I think is probably a right thing to do in this case because it came in at $5 per share. If we take all the other valuations that came in at a respectable price tag for the company, then we're looking at 126 is currently fair market value for Dollar General today. And honestly, if we can get it down into this range, like 105 to 110 range, might be an area where you can maybe consider um, beginning a position in Dollar General if you think this thing can turn it around and start making money going forward. But I drew this trend line in here from the very beginning, from IPO here in 2010, and it's just been a steady trend line up. So maybe what we're doing is we're coming back. We're going to pull back down to this trend line here at about 105 range, which gets us within the 30% margin of safety range. It's maybe closer to 20% of this company. And if you like Dollar General and you see value in Dollar General, maybe this is a perfect idea or perfect time for a position to start. I wouldn't back the truck up on it personally, but I personally won't touch it at all unless their financials start turning around. But that's my take on Dollar General. I had a little bit of a summary here on the valuation. They're still buying stores. I don't know if that's a good thing or a bad thing. To me, I think that's a bad thing. They have really nice return on invested capital. Nothing to be, complain about there. The bad overall outlook of the company looks very questionable. The management isn't providing any really positive feedback on the outlook of where the company's headed. I think there's a risk of the dividend being cut or slashed or eliminated in total. Who knows? If they need the money, they have to pull it from somewhere. And as of now, their free cash flow is negative, which means that will eat into their current cash pile. And that's something I didn't show you. But if you come to over here on their cash flow statement, the let's see here, beginning of period, they had 382 um, million dollars of cash, and now with this being negative 41 million, they only made 9.4 million based on their financial activities, and that gave them a 28 uh, million-dollar decrease. So then that's going to take away and eat into their cash pile going forward. And I think it's if they can't turn things around, it's just going to eat into it even more, and then they're going to run out of cash, and they're going to have to pull cash from somewhere to eliminate a dividend, or maybe sell some buildings and cut out leases and stuff like that. So they've got some work to do. That's it for this video. Let me know your thoughts on Dollar General. Maybe you guys think something different than I am. I'd like to know. Put it down below. Also, if you found value in this video, consider liking and subscribing. But that's it, and we'll be back tomorrow with another stock valuation.